Hi there, folks. Marc from Able Capital Partners here, and I'm here to give you an update on the housing market as it relates to Marcus Millichap's recent housing report. So the first thing we're going to talk about is the 30-year fixed-rate mortgage, and that's more than doubled since the beginning of 2022. We're now sitting in the high sixes according to Bankrate.com. What does that mean for home buyers? Well, basically, they've increasingly chosen to sit it out, to sit on the sidelines in light of those higher rates, and in hopes that they'll recede in coming months. As a result, home sales have fallen to a 27-month low, and that's causing sellers to ease up their pricing expectations. That pricing has fallen across the nation for the third straight month, and developers are also taking notice. Developers have pulled less construction permits, and they've fallen to a 2-year low. However, less permitting could actually be a good thing for us as multifamily investors, as a lot of those projects which aren't commencing today will mean less supply 12 to 24 months from now. Less new homes at that point could mean more renters for us. Now, contrast that lower supply with the fact that more than 9 million new households are projected to form over the coming decade. And after all, household formation drives housing. However, while this could be good for us multifamily investors over the longer term, there are signs that choppier waters are ahead in the near term. The Fed is absolutely obsessed with taming inflation. Jobs be damned. Their cooling of the economy will likely mean unemployment will tick up in the coming months. Usually when unemployment ticks up, it means higher vacancy rate and higher instances of bad debt for us as multifamily investors. As our tenants incur job losses, that creates more pressure on us and our bottom line. Marcus Millichap projects that vacancy rates will return to pre-pandemic levels by year end after being historically low for the past 2 years. So higher rates have an impact on us as multifamily investors in a number of ways. Number one, it increases the cost of financing for us as investors. Number two, it can actually, as we mentioned earlier, impact the amount of supply coming online as it hurts developers and their ability to finance their projects. And number three, if it slows down the economy, it can have an adverse impact on our tenants and their ability to afford the rents. And number four, vacancy rates. Usually as inflation and as rates rise, it can have an adverse impact on tenants as well on the vacancy side, as maybe they will move in with friends or family, and that will actually hurt our vacancy rates on the investment side. Well, hope you've learned something. And for more information, we'll include a link to that Marcus Millichap report, which we cited throughout this video, and encourage you to dig in and do your own research and draw some of your own conclusions from this really insightful report. On behalf of Able Capital Partners, be kind, be charitable, and invest wisely.